US stock markets experienced waves of optimism the past few days as investors' risk on sentiment return in the markets, supported by the solid start of the earnings season. Nevertheless, dreadful economic conditions continue to loom over the markets, with investors being bombarded with negative headlines in regards to skyrocketing inflation, geopolitical unrest, intensified recession fears, and a stubbornly aggressive stance by central banks across the world. In this report, we aim to reconcile the latest earnings results of Netflix and Goldman Sachs during these erratic times. Netflix, the entertainment service giant, saw its shares jump by 13% at the time of the release of its earnings report, where it exceeded both EPS and revenue projections. More specifically, the third quarter earnings per share figure amounted to $3.10 per share, beating estimates by $0.93, where the revenue figure amounted to $7.93 billion, beating analyst estimations by more than $82 million. Another positive surprise from the reports was the paid subscriber growth number for the quarter, where the company added 2.41 million new subscribers, pivoting away from its lackluster performance in previous quarters where it lost more than 1.1 million subscribers combined. Furthermore, the growth in subscription is expected to increase in the fourth quarter, also with projections reaching near 4.5 million paid memberships. On another note, the streaming giant will introduce the low-cost subscription plan with advertisement in an attempt to attract cost-conscious users in early November, but also provide an incentive for traditional TV-based advertisers to partner with them since the TV audience is shrinking. Even though the upside surprise of the results lifted Netflix share price at the time of the release, the company's stock price remains beaten down by a whopping minus 60% on a year-to-date basis as the US equity sector falls victim to the Fed's aggressive intents. Goldman Sachs shares were on the rise yesterday after its Q3 earnings releases, beating both earnings per share and revenue forecasts. More specifically, the reported $8.25 earnings per share figure topped the $7.51 per share estimations, and its revenue for the third quarter increased to $12 billion, beating estimates of $11.5 billion. Impressive was the performance of trading and investment banking divisions for this quarter once again, but not of the same magnitude, reporting profits north of $6 billion, capitalizing on market volatility spiked by wider geopolitical uncertainty, deepening energy crisis, and soaring inflationary pressures that defied restrictive monetary policy practices by central banks around the globe. Furthermore, the Wall Street Bank announced an organizational realignment merging investment banking and trading divisions in an attempt to make operations more efficient, doubling down on its traditional strengths, while it decided to tone down its consumer banking division as the operating expenses and provision reportedly weighed down the banking colossus. Concluding, more demand destruction and downward pressures are seen ahead of equities as Fed appears united and committed at taming inflationary pressures by deploying relentlessly in its monetary policy tightening agenda. The market is currently pricing in another jump of 75 basis point rate hike in the early November meeting. Hence, in our assessment, given the challenging macroeconomic environment and a worsening global growth outlook, we hold the view that US equities are to face more headwinds, and any rally amidst the bear market is expected to be short-lived. Thank you for watching.